This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan. As we take you through the rest of this hour, futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tasty Trade. If you're on the website, tastylive.com, welcome to the show. Tell us what you think of these markets. We will be watching the chat, as I recently learned, guys, been a little bit softer in Futures Power Hour. Apparently, they've been shutting down the chat. We're not trying to avoid criticism. So that's going to be live. We'll be monitored. Feel free to chime in. Other than that, guys, it's a day where the NASDAQ here leads the way, lower off by about 1.3% right now here after hours. Now we find ourselves with an S&P up by about 0.5%. Chip makers are the big loser today. Sam Altman over at OpenAI says that we may be living in a bubble akin to the dot-com bubble of the late 90s. And sure enough, those stocks that have been flying high are the ones that are turning lower in today's session. What was hot is now cold. Bonds are up across the curve, though. And a curious thing in the currency space, it's your yen, your Swiss franc, and your US dollar as the top performers alongside those lower US yields. A little bit of a risk-off flavor to the whole situation, Ilya. Otherwise, natural gas breaks lower. This Hurricane Erin is turning out towards the Atlantic. Maybe some nice waves for surfing if you're in the Outer Banks. But beyond that, going to avoid critical energy infrastructure as it does not turn towards the Gulf. Natural gas is smoked. We have obviously cooler weather here in the northern tier of the country this week, so energy demand a little bit lower. Heck, windows are open all throughout my house today because the high is 74. Beautiful. Outside of that, though, gentlemen, we go into a day where Dylan, the godfather of the AI movement, if not for Jensen Huang over at NVIDIA, it has to be Sam Altman, who's led the ChatGPT revolution. He's telling everyone to curb your enthusiasm. The supernova is not so super. Do you doubt him?
I don't even think he means it.
He's a liar.
But it's not that he's a liar. It's in the interest. If you are one of the if you're one of the leaders of a movement like this, which he is, it is in your interest to there's no value in, like, it's one thing for me to sit and say, oh, this is a supernova, or for people with bigger platforms at Goldman and Morgan Stanley to say this is the future. But if you're one of the CEOs of one of the big five, which he is, he has every incentive to to diminish or to calm the water, if only to sort of lower the he has every reason to lower expectations. Expectations are, beyond infinite. And so lowering expectations only helps them meet expectations. But I don't think that it's really a referendum on AI, not AI, supernova, not supernova. It's literally just a little jibber jabber from somebody who has a self-interest in calming the waters to make a value, maybe a marginal argument on value, on short-term valuation, which, if anything, I would say is an opportunity. I mean, what a great day to buy Microsoft, by the way.
Oh, yeah. We saw that there was some news this week that OpenAI could be fetching a $500 billion valuation in private markets. To that end, this news of Sam Altman saying that things are getting too far too quick may be a reaction to that, obviously. Managing expectations is important. You don't want to get too far above your skis, but there's also been some technical damage here in these markets following the news and the sell-off today. Microsoft down below, closed below its 1 month moving average. We haven't really seen that occur here going back to April. Meta, very similar situation, certainly losing the thrust of the move higher that carried us in August. NVIDIA, obviously the flag bearer of this entire rally, that's down below its 1 month moving average on a closing basis for the first time since late April. So the characteristics of this rally are evolving.
Yeah.
Can you mention the risk this week without mentioning the J whole word?
I don't think you can, because when you look when you look at what happened today, you have to look cross markets. It wasn't just Altman, though that certainly helped. You look across markets today and you get a dollar that's higher, you get gold that's lower, no real movement in the front end of the curve, but the long end is a little is a little higher. Yields are a little bit in. So you get this kind of maybe the Fed won't give us all the rate cuts that we want, and that's bad vibe as you look cross markets. I mean, obviously, NASDAQ underperformed, and I don't think there's any reason to think that there's anything that you need to overthink there. I mean, obviously, the godfather of the current AI age tells you it's a bubble, and I agree with Dylan. By the way, I mean CEOs sort of famously attempt to underpromise and overdeliver. This is sort of the quarterly exercise of you guide modestly so you can beat your quarterly number so the stock goes up. And obviously OpenAI is a little bit of a different story in that sense, but the sort of the philosophy of managing expectations down so that you could beat them is no surprise to anybody. So I don't think you read into that. What I think you read into is how reactive the markets are, though we all know this from every quarterly earnings report ever. Why does this move markets? That's the question. Because he didn't say anything that you wouldn't expect him to say. He didn't say anything that wouldn't have been written off 2 weeks ago. I mean, Elon has been saying that this is some kind of a overshoot and raising a lot of these same concerns for a while. Now, granted, he's been somewhat put on timeout for all the other things he's said, but nevertheless, in this space, he knows what he's talking about. Likewise, nothing Sam Altman said here is unusual, to Dylan's point, for a CEO to say. What's interesting is that the markets didn't like it to this extent.
I would agree with that. I mean, I think that that's sort of like, it goes to the point of the fragility of the valuations right now.
Yes.
That there is even any a cautionary words from anybody that they're taken seriously enough to sell these names.
That's right. That's right. Because who amongst us thinks realistically that, okay, these valuations are perfectly fair and not at all frothy, even in the near term? I don't think anybody seriously thinks that. If, on the other hand, you say, oh, well, this whole thing is all hype and there's no substance there, ridiculous. Obviously, this is a transformational technology with lots and lots and lots and lots and lots of runway. You should be able to hold both of those ideas in your head at the same time. So that the market was this reactive is the interesting thing. And I agree completely with what Dylan is saying here. This speaks to the fragility of sentiment. And that fragility this week hinges on the Fed. So that the market is reactive to this news the day before the FOMC minutes come out and tell us whether the Fed is likely to be any more dovish relative to what they said in July as stage setting, yes, for Jackson Hole, where they're going to set everybody's lens up for the next year. That's not a coincidence in my mind. That's an excuse.
What's an excuse?
The Altman comments. The markets wanted to sell.
Yeah. That whole thing's sort of squirrely anyway. And
the markets wanted to be selling.
I can agree with that.
And they got a headline and they said, "Ooh,
it's a reason to sell.
Here's something."
Mm-hmm. I can hear that. I can get with that.
Yeah, well, you mentioned this is from Yardeni.com. Ed Yardeni is a market strategist, but he publishes these free charts on his website for anyone who wants to go check them out.
Fantastic charts, by the way. I use them all the time.
And they're updated daily. So some of them are weekly, depending upon the data series.
He's still doing money flow?
He's doing everything, man.
I mean, he was the king of the old money flow.
Big shout out to Ed Yardeni. This site is awesome.
And Hungarians around the world, I might add.
Quite.
Are you on the Hungarian Airlines payroll like Eric Adams?
No, but I'm a Hungarian.
Oh, I didn't know that. Good for
Also,
you.
I think he's on the Turkish Airlines payrolls, air
Yeah.
account.
I mean, how do you think I come by my
So is Dylan.
if not for some Hungarianism?
Your mother? I mean, I don't know.
Don't let the
Budapest,
Vatican
by the
fool you.
way, some of the greatest eating anywhere in the world. Absolutely fantastic.
Fantastic. And Hungarians, very smart people.
Was that in question?
I mean, let's just be not.
Okay. Thanks for clarifying.
Yeah.
The point
Bring this
here.
back to Ed Yardani, who is a smart Hungarian. Anyway,
Sure.
you were saying.
We can see that, Dylan, you mentioned the valuations in question, perhaps the fragility of the market. Underlying all this for your average investor is right now, if you're allocating incremental dollars, what are you putting this into? The S&P 500 forward PE ratio is sitting at the levels that we saw post-COVID highs, which then are only preceded by levels that we have around the dot-com era. Really, no matter how you slice it, if it's information and tech, mid caps, you're in a place where it's just uncomfortable. The first chart up here, I think, is the most interesting one because it's the everything else versus the Mag 7. So Mag 7 isn't even at its post-COVID highs yet, but if you're a large cap stock, you basically are going back to 2021. Fragility. What solves this? Correction in price or correction in time? Earnings need to catch up to substantiate the view, or markets need to cool off. That's not to say that things can't keep inflating. They can, but if you're at a moment where people decide to take their chips and go home for a little while, contextually, the market's a little bit more fragile as along when valuations are inflated than when they're on the floor. So I hear you, Elia.
There was a tidbit that came out, and obviously you can pick whatever your valuation thing, and everybody's going to quibble about which thing, but this is just a factoid in your quiver. B of A came out with a chart yesterday showing that S&P 500 price to book value ratio is now 5.3 as compared to the peak in 2000, the dot-com bubble, of 5.1. So we are a little bit past the peak for where .com popped. We're way out of sort of standard deviation territory. Average is 2. That's going back to 1946.
It's warm. It's hot.
It's warm.
Can't deny that. Can't deny that. The big names, though, that pull back. The high flyers, Oracle off 5.89% today. Palantir, which has been a high flyer, this is down 9.35% in today's session. Net, yeah, you're off another 3.84% yourself. Netflix, that's down 2.48%. So some of the things that have been carrying this market to the upside, obviously coming down for today's session. But Dylan, you're not seeing this as a bigger problem. And you know what? You're right. I mean, expectations management. Haven't we been saying this for the past 2 weeks in the summer? If you have a time with your equity prices up at all-time highs, what a good time to try to lower the bar, get bad news out there, clear the deck for the second half of the year. The worst thing that happens is you get a runaway into sky high of an expectation, you fail to meet it, and even though you're a success, you as an executive are wrung out to dry because, well, you didn't manage the public perception correctly. There's got to be some.
That's the whole thing. I mean, I think that's the, and it's like, again, I mean, if you were inside of something that's sort of in this wild and crazy movement, like the more you can back it off, the better.
Mm-hmm.
If you're long the stocks, if you're me and you own something, you're like, this is going to be, the future is now, but if you're inside the boardroom, much better to sort of back the crowd down, because God help you if it's because you're talking about, the cliche is price for perfection, and you don't, no one wants to have to operate an organization that's priced for perfection, because obviously there's execution risk and timing risk and unknown risk and all the rest of that. So I just think that I'm more interested in the stock behavior than the rhetoric, which
especially if you're the big incumbent, and you want some of the optimism that others might use to raise money to come for your piece of the pie. You probably want some of that optimism to be contained. Now that you have first mover advantage secured, you want as big of a moat around your position as you can. And the more optimistic things are, the easier it is to raise money, the easier it is to come for your crown. So doesn't hurt to tamp things down a little bit if you're Sam Altman.
A lot of these things are still priced very well. I mean, you looking at iDrive today, which is the self-driving EV and tech ETF, it did hit a new all-time high in today's session. Names that typically have not done well, even like an ARC, that was pushing up towards yearly highs, and today it takes a 3.98% drop. So everything risky is coming in. I can't help but notice that you have Ethereum, a high flyer, that's off. Bitcoin price is down another 2.92%, losing their breakout. Look at this double top potentially in play here now. So there's a few things going on in the market that just risk in end of summer. That's your story.
Yeah. This is sort of why I can't blame Sam Altman's comments in isolation. I mean, obviously there's a larger risk off thing that's unfurled here, and that's not one comment from one CEO. That's a market that wanted a catalyst, found one, and went.
That said, Dylan, the uptrend remains. We're still in a market
That's why I think you buy them. I think today's an opportunity.
That is ultimately, if we're thinking about this, right, Ilya, we failed to break out here. We're losing ground. S&P in this 21 50-day envelope, you know, you find yourself cutting into 63.60 to 63.80 the next few sessions, first blush. Have to think they're going to be dip buyers there. Similar to the NASDAQ up near 23,000, we'll call it 240, 250. Volatility has not expanded all that much. And that to me is the really important telltale sign in this market that yes, selling picked up over the course of the day today, but I'm just going to bring up the SIBO term structure here on the screen. The front month, September 19th expiration, 1561. The back month, June 2026 expiration, 2179. It's still north of a 6-point spread. When the term structure's been in a 5, 6, 7-point contango and hanging in that area, dips have been bought. And the sell-offs haven't been that that sustainable. Even in early August, when you had that pullback around non-farm payrolls, what occurred? Yeah, vol went up minorly, but you remained in that steep contango. And by Monday's session, the market was rallying again because volatility didn't really dislodge itself. Dylan, if vol is our North Star around here, and I really think it is, and you look at the volume in this market, barely getting past 1 million contracts traded today. This is not a material setback.
I don't know about that. It's not the setback that makes for a trend reversal, confirmation, sure. But also note that you had a very clear high established in the latter part of July. You then broke out above that high, and you've now shown that breakout failing. Those are the makings of a top, if you can confirm it. When you have a breakout very clearly over a clear peak, and instead of finding follow through, it turns out that there's no ground under Wile E. Coyote's feet, and you fall back in and undo that breakout, that's a significant amount of technical damage. So
can you square the circle with me? If this is as bad of a sell-off as we think it is, or you're suggesting it may be, why are all the rate sensitive things like home builders, which would ostensibly be very sensitive to the broader state of the economy, why are the home builders doing so much better?
Look at ZT. We're getting the rate cuts. The things that are actually up for speculative interest are not rate cuts this year. In fact, if you look at where the market has been on rate cuts this year, we've been hugging 50 basis points plus or minus for 3 months. The market is convinced that they're going to get the same thing the Fed told them going as far back as December. That's not where the speculative fervor is. The speculative fervor is next year and beyond. And what we've seen now is over the course of the past several weeks, you've gone from 75 basis points fully baked in to today down to 66. That's not nothing. Moreover, you go out now to 2027, which is starting to get some liquidity in those contracts, and you've gone from a rate hike being baked in to that going away. So you're pushing on the timeline. You're saying less next year, so maybe more the year after. And obviously the markets don't want the year after, and they don't want next year. They want now. So when it comes to speculative fervor, it's further downwind, and it's not about refi costs in the immediate. It's about sentiment. Because just like we were saying on last call here, this market is out of positive things to say, but for eventually the Fed will have some rate cuts. What else isn't in the price here? The tariffs and the whole will he, won't he, is it a negotiation, or are we in fact going to cut off our nose to spite our face? That was the first half of the year. That story's over. We know what that is now. So the wars in Russia and Ukraine have been going on for years. The Gaza-Israel theater has been now going on for years. That hasn't moved the needle at all on crude oil, so it tells you how much the markets care about that.
Well, Dylan, can we actually switch to that topic here? I couldn't help but notice that we're getting reactions, and more importantly, we're getting further follow-ups to this major European leader summit yesterday at the Oval Office. You have your ear closer to the ground for European news sources. What's the perception about how this shapes the outcome of this Russia-Ukraine conflict?
I mean, I don't want to sound like a broken record, but I really believe that the perception is that they have no leverage. That all of this is ritualistic, and that Putin will do what Putin will do. And that basically this is posturing to maintain the appearance of engagement in order to sort of keep everybody hopeful. But I actually think that the only point of leverage is actually with Zelensky, right?
Why do you say that?
The leverage with Zelensky is give up the eastern portion of Ukraine in exchange for security guarantees. And I don't know whether he's going to do that. But if there's any leverage in this, it's actually the Europeans and the Americans as a counterparty to Ukraine, as an inadvertent advocate of the Russian agenda in exchange for peace. And remember, Ukraine is not the star student of European life. You know, it is a historically corrupt and unreliable country in the scope of European economic activity and culture. Important because of the massive resources on the agricultural side and on the mineral side. It's a critical warehouse of commodities. But this is not, you know, you think the French and the Italians don't like each other, or the French and the British don't like each other. You know, there's a natural need to close ranks and ally around the defense of Ukraine relative to Russian aggression. But there's also a point where there's only so far everybody's willing to go to do whatever the Ukrainian president wants. And there is a point where people say, listen, you lost. This is a war. You lost. And we need to make a deal and we're going to draw some new lines. I'm not even saying that that's going to happen. I'm not making a prediction. I'm not suggesting that that's what's going to happen. But I'm just suggesting that in the scope of influence, that European leadership and American leadership has some influence in Ukraine, much more than they have in Moscow.
Certainly. Ukraine is very, very important. And the reason that Ukraine is very, very important and has been very, very important going back to sort of competition between Russia and the Austro-Hungarian Empire and the Ottomans and you name it. It has been an absolutely critical geographic location because it is one of the poorest points through which Russia, historically, going back to Ivan the Terrible and the formation of Russia as a polity coming out of Mongol occupation, it's one of the key choke points for Russia to want to close because Russia is a flat terrain and it is constantly attempting to move the goalpost, to move the sphere of influence to defensible geographic barriers, be it the Ural Mountains, be it the Caucasus, be it the forests of Ukraine, because Ukraine is the gateway to Poland, which is the gateway to Europe. So this is a critical geopolitical and geostrategic spot on the map and has been since the beginning of time. Because
but I mean, do you disagree with me, Ilya, in my perception that the European and American leadership's leverage with Moscow is effectively nothing?
They have next to no leverage at all because Putin has gotten himself into a place where
he's now the incumbent.
He will fight this thing to the last dead Russian, in which case he's screwed anyway, or he backs off, in which case he's the only one that's screwed because then the wolves inside the Kremlin will recognize the alpha is weak and eat him.
So when you would, because the argument a few years ago was, well, if you give Putin an inch, he'll take a mile, right? The Baltics,
yes,
Poland, all the things.
Well, it's
do you buy that?
Czechoslovakia and Hitler again,
right? But I thought personally that was bullshit. I thought that the Russian reaction was a reaction to sort of NATO perceived Western encroachment. I
disagree, but
you do?
Sure.
I mean, so
you're like a John Mearsheimer point of view, Dylan?
I mean, yeah, I mean, I don't want to get, but it's not a pointless, it's not an argument worth having in this.
Yeah, it's not a market relevant.
And I don't even know that I'm right. So I'm not willing to go to the mat on it. I just have an opinion like any other fool on the street. So I'm not going to worry about that. But I do wonder, do you have an opinion, Ilya, on my assertion that the Americans and the Europeans have a limit as to how far they'll go for Ukraine, and that they're willing to sort of use their leverage to ease Ukraine into some.
I think the Europeans, because of how critical Ukraine is to European security, and because it is such a critical point territory-wise for what you have to hold and where you have to keep the east and west of Europe separated. Both sides want dominance over this spot because that's the choke point. I think the Europeans will go much farther, and I think their commitment to Ukraine, it's not about Ukraine. It's about Poland and where the EU begins. It's about the Estonias and the Latvias and the Lithuanias of the world. It's about Finland. The question is about that and not about Ukraine as such. And I think for the Europeans, this is a hill they will die on. And the reason,
because you think Russia poses an actual risk to continue military activity. Beyond
absolutely,
that you think that that Lithuania or Finland has legitimate risk.
Absolutely, because I think if we learn from what Georgia was in 2008, and we see that as a playbook that is completely being repeated in Ukraine, I think, fool me once, shame on you. Fool me twice, to quote George W. Bush. The point is, you can't fool me again. So I think the idea that Russia is trying, as ever, to close avenues for invasion of the mainland It isn't new. It's an idea as long as Russia has existed as a polity. That has been the strategy all along. Do anything you can to prevent a Mongol / Napoleon / Nazi type of situation where the heartland has been invaded, because there's no defending it. It's vast and flat, which is why in both the Napoleon case and the Nazi case, what ultimately ends up winning the war for Russia is death of ridiculous amounts of Russians in a war of attrition, and the weather. The winter is just very, very cold. And occupying Russia in that kind of a climate is very, very difficult. So I think in the minds of anyone, I mean, I'm from Russia. I was born in Moscow. In the mind of anyone from that part of the world, you ask them, name a Russian war. They're not going to tell you about the Russo-Japanese War. They're going to tell you about Napoleon and World War II. Because those are the things that speak most directly to the quintessential geopolitical strategy that Russia has employed across czars and commissars, and now this, whatever this kleptocracy thing is,
President.
Since the beginning of time. They want to control geographic barriers to invasion. One of them is Ukraine. It's not the only one. And so, of course, they will try to reestablish the same perimeter that the Russian Empire had, the same one that the Soviet Union had. Of course, that this has been the strategy now and forever.
I don't think they should be worried about Europe invading them.
No, they shouldn't,
soon.
But they are.
Yeah, well, something about air conditioning and not being able to survive the weather would make a lot of sense here, but that's a different story. Dylan,
that's the thing. Nobody is trying to.
This guy and his air conditioning. It always comes back to the air conditioning with this guy. This guy can't be bragging about his windows open, bragging about the air temperature at his house.
I have the fan on and the windows open. It's actually a very American flex right
his
now.
Bakery, his cinnamon buns. He's always trying to show off his baked goods. This guy.
It's true. I am.
American exceptionalist right there is what he is.
My milkshake brings all the boys to the yard, Dylan.
We blame him. No.
I can blame gold for a lot of things. Gold's been just a terrible long trade, but at least, directionally neutral, not awful. Ilya, it's down by 0.54% today. I can't help but see gold down, oil down, part of the same story here as it pertains to geopolitics, because the volatility is coming in on both. I mean, is that this is my next question though, assuming we're getting an end to this war in some form or fashion.
Eventually.
Right? There's a lot of money was pumped into gold after the onset, although gold doesn't really have its big run up until Israel, Gaza go down.
Yeah.
Gold hits $1,900 an ounce when Russia initially invades Ukraine. And then it spends the next year and a half gently sliding back in.
Mm-hmm.
So with the news of the hostage deal today with Israel and Hamas, with a potential,
maybe.
Well, it directionally, the impulse is towards de-escalation right now, even if there were flare-ups.
Last I checked, there was reporting that Hamas has accepted a Egypt and Qatar created idea, but we haven't had confirmation. Last I saw from Jerusalem, did Netanyahu say yes?
No, I doubt he will, because it means the war ends and he can't let it end.
This is not his, he's not attempting to end this thing, clearly. But the amount of protesting in Israel demanding that this end has been historic. I mean, hundreds of thousands of Israelis have taken to the streets to end this thing.
Yes, I've seen that.
So maybe the critical mass is there finally.
No, I don't see anything on the Israel side. I don't see anything on the Israel side here that would suggest that there has been actually a ceasefire. So yes, you're right. My mistake. So Hamas has agreed to a ceasefire deal, which means nothing without Israel. And likewise, if Israel agrees to a ceasefire without Hamas, it means nothing.
That was the last version of this back and forth. Was Israel agreed to one, and then Hamas torpedoed that one. So
it's just increasingly feeling like the path of least resistance for the metals. 36 in silver, 3,300, maybe even 3,200 in gold. Right now, the dollar's bouncing back, and I think that's perhaps the most important part of all this. Gold is down on a day where the dollar is up alongside lower U.S. yields. This is still a period of higher highs and higher lows. And we know from the recent fund manager survey that this is still one of the most hated trades in the world, where the dollar is actually the most shorted currency right now. It's an extreme. It's still an extreme in sentiment. So, Ilya, what's the play here? Canadian dollar was one of the big losers after their inflation report.
I like that.
The loonie in the coal mine. The Canadian dollar, their low inflation, 80% of their exports come to the U.S. Yeah. Surely this means that our economy's slowing down in some form or function.
Well, we know that that's going on. In fact, as we kind of get ready for the FOMC minutes tomorrow, let's remember Powell himself in the press conference after July's FOMC acknowledged that there were mounting risks to the labor market. Even as he said, look, it's not that bad yet. The economy doesn't look like these rates are too restrictive. We need more time, blah, 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 blah. But even he said, look, obviously, we can see that threats to the labor market are building. So nobody's surprised, or should be, that the economy is slowing. One of the more interesting things is Canada, of course, has been the loonie in the coal mine for a long, long time. But last year, it sort of decoupled, where the economy in Canada was very, very weak. The economy in the U.S. was very, very strong and not spilling over. And the reason it wasn't spilling over is because most U.S. imports, including from Canada, are goods. And all the boom was in services. And most services demand is handled by domestic U.S. firms. So it didn't really spill over into Canada. Canada's been in trouble for longer than there's been a U.S. slowdown, as it were. But you do have to look at it, and you do very often get early signals for what's going to happen in the U.S. business cycle, because the situation in Canada does seem to be going from soggy to soggier. And certainly the trade war escalating now. By the way, despite the president's own trade agreement, the USMCA, apparently now there's we still have 35% tariffs on Canada. We're going back and forth. We'll see how all of that goes. But I think very, very clearly here, the Canadian dollar is especially hampered relative to the others, but it's not just it. Look at the Australian dollar, which isn't attached to the US at the hip. It's down big today. And it's just commodity currencies and a risk-off market. The Kiwi, the New Zealand dollar is down a lot. On and on and on. Sort of these are the currencies taking it on the chin here. The stock adjacent ones.
Dylan, that is one thing that's different now. I mean, I think about 2022 and 2023, we could have pointed to something like DJP or DBC, which are the commodity tracking ETNs or ETPs out there in the world. And you would have seen that while we had these big worries, let me just actually go back here. We'll go to a weekly chart. More than 3 years to make this point. So we'll go back. Okay. So you could see that when we were going into the, inflation concerns of 2022, there was a run-up happening in commodity prices. There's no concurrent run-up in commodity prices right now, as we have all these concerns filtering through to the broader market about inflation generally. Is that something that we should be ignoring? I say that if only so vaguely to suggest that isn't this a problem? Aren't commodities the whole economic story distilled down without all the BS? There's no hype cycle here. This is just true supply and demand. And if commodity prices are pointed to the downside, it's a clear indication that economic demand is stagnating.
Maybe. I don't tend to, I think the commodity price behaves as much as a currency inflation measure. I mean, obviously, over over short periods of time, I believe commodities behave more as a current, as if as an alternative currency, basically, slash an alternative inflation measure. Over longer cycles, obviously, that's not the case, and this doesn't look like that big of a move. So, I mean, I could also make an argument that the American tariffs and the sort of deglobalization drive more regional, demand, less global demand. I don't know. I'm not willing to look at that move and say that that is a yellow flag on economic activity. I'd be interested to see what's going on at Burlington Northern on the railroads. I'm more interested in FedEx, and I know that those aren't necessarily great numbers either. But if I'm going to go into your sort of like super macro upstream indicators, I think the railroads are probably your best. Maybe the ship. I don't know if there's a shipping like but even the ships are a bad indication right now because it's not necessarily a demand indication. It's sort of an adjustment in a marginal global trade adjustment because of the tariffs, which is why I prefer the railroads. Because if the railroads are not running paper or running product, I should say, that's a lousy indication. FedEx also worthwhile. But there's a good one. PKG. It's flat.
Yeah, for corrugated boxes.
That's a good one.
Yeah, I mean,
I love those better than DBC. Listen, the commodities are fabulous over a longer cycle, in my opinion, but for short cycle stuff, I don't. I think it's more ties to whatever's going on with the dollar, or rates, or inflation expectations, as it does economic activity.
Well, and you don't have to go far. I mean, we already know from the most kind of catch-all data you can imagine, the second quarter GDP data. I mean, GDP is slow and cumbersome and is usually too late. Even from data that's that heavy duty, we already know that in the second quarter, consumption was weak again after weak consumption in the first quarter. We know that taken together, that was the weakest 6 months of consumption in 5 years. 5 years before was the COVID recession, so not a good historical analog. We also know that inventories fell in the second quarter after running up in the first. So it's not like they're being restocked. So the front running of the tariffs is not continuing, despite, by the way, the 90-day pause that was still very much effective in the second quarter. So demand isn't there. We also know that imports fell, sort of reiterating the idea that whereas in the first quarter everybody was front running the tariffs, in the second they started to spend down those inventories and didn't replace them. That tells you demand isn't there. Businesses are not making provisions for selling more stuff. You also know from the PPI report that businesses are starting to pass on these tariff costs. Margins are expanding back out. So they're not afraid of killing demand. That tells you something too. They want to get their money while they can. So it's not like we don't have very clear indication that the economy is slowing and that this is somehow news to anyone. when the Fed is talking about it directly, and two Fed governors dissent and want a rate cut, and Powell says, yeah, I think they're right, if not for these tariffs, I think we don't need to search very far. We don't need to go and look for esoteric indicators.
Oh, well, I'm going to give you an esoteric indicator. PKG plus SLVM, SUSE, CLW, Merck, and FDX. These are all paper product, paper pulp, wood pulp, yada, yada, yada type of companies. If you wanted to think about this from the shipping perspective, Dylan. So I tossed the FedEx in there too.
Sure.
Using 100 as our index reference point for where these share prices closed cumulatively on April 2nd, prior to Trump's after-hours Liberation Day announcement.
I'm assuming that big downdraft is Liberation Day.
That's April 3rd. That's the following day, right? We still have not recovered back to our Liberation Day level. We're at 91.6. So this basket, in theory, is still 8.4% below where it was relative to Trump's Liberation Day.
Which I think is sorry, complete your thought. I'm sorry.
Well, I think that's actually an important indicator for how the global economy feels in general, how investors feel about the state of global commerce here.
I would say that's more global goods, right? That's not services, that's not tech, that's global objects.
Services, though, if we're going to be spending less stuff on atoms and more on bits, right?
Yes.
Digital ones and zeros, and less of the tangible.
Services, travel, transit, hotel rooms, whatever.
Well, travel goes up too, right? Because now the replacement part for airplanes and everything are going to go through the roof.
Anyway, you're making an important point here. Carry on, sir.
But Ilya, you could see it in the CPI data. Core services inflation was actually higher than core goods inflation, and so consumers
But the thrust is going the other way. Core services inflation was down from the prior month. Core goods inflation was up.
Right. The point I'm getting at, though, is if there's a bottleneck here, people are seeing that there's going to be real global economic slowdown, but dollars still have to flow somewhere into the economy.
Yeah.
And it's created this bottleneck in digital services again, almost akin to how the market reacted post-COVID, Dylan, where once the stocks market starts rebounding, it's all tech on the way up, and the real economy goods are the ones that are suffering. I don't know if there's anything there to it, but if we were really thinking that there was robust global growth coming around the corner and we weren't really so concerned with a tariff bite, I would argue that this basket of companies would be trading higher than where they were pre-Liberation Day. And obviously the index is still below 100, so they're not. People ship things.
Trading higher? Why would they be high? Why would they be higher?
Cardboard boxes.
No, but why would the index be higher?
In a world in which economic activity isn't at a lower baseline today than it was on April 2nd, there'd be more demand for paper products.
Just because, let's say, economic activity is not necessarily at a lower baseline, does that necessarily mean that international trade in goods is not at a lower baseline? That on the margin, the sale and purchase and sale of imported goods, exclusive of domestic goods, exclusive of global services, exclusive of global tech, that there's a unique penalty right now that's being assigned to imported goods specifically, and that is limited in scope, or that the perception is that that's limited in scope. I don't disagree with you. I don't see how it's possible. Like I said, we had this conversation when I was on the phone with you guys last week. Mm-hmm. How is it possible to raise the price of everything and not have it reduce demand? It's sort of, economics, freshman economics 101.
Well, I've been having this argument with people when it comes to housing and tariffs. I keep hearing people say tariffs have no impact on housing. Well, if you raise the cost on lumber, and the lumber that we use to build our homes, really the best quality lumber comes from the north. Growing trees in colder climates leads to denser wood. That's why, you can get southern lumber in, South Carolina, North Carolina, but it's not the same quality as lumber you get from Canada. So we're going to have lower quality homes, sure, but if we want to have higher quality stuff, you're going to have to pay more money for it. So what do you mean pushing up the cost of lumber or increasing tariffs on steel or copper or aluminum, things that go into building a home? What do you mean that that's not going to push up the cost of a home?
Of course it will.
It's crazy. It's just think about that.
Again,
right?
Econ 101.
Right? Like I hear people, the same people make the arguments. Oh, well, how much is a hamburger going to cost at a fast food joint if you raise minimum wage to $30? Forget the fact that it's labor. It's an input cost. You're making the same argument that I am. Raising an input cost is going to lead to a higher end product cost for the consumer because the company naturally doesn't want to give up its margin. It wants to make as much money as possible. So if it can pass it on to a consumer, it's going to. It's going to be a higher house cost. It's going to be a higher hamburger cost, unless it's done in a reasonable, measured way that, of course, doesn't disrupt economic activity, which we won't do because that would make too much sense. Dylan, we have 5 minutes left here. We haven't touched on a few things this week, but we have the second half of the week to go. So I do want to avoid Fed-related conversations, Ilya, until tomorrow after we get the minutes and then getting ready for Jackson Hole on Thursday. Mm-hmm. Broadly speaking, though, I saw that there was a big shift between the housing numbers and the building permits today. Housing starts are up, but building permits are down. Permits, of course, feeding to housing starts. You have to get them permitted before they can start being built at the end of the session. But what does it tell you about the state of these rate-sensitive sectors right now that we're seeing biotech, housing, utilities, even staples start to move to the upside? Typical defensive type of.
This is a question for me?
It's for Ilya. Question for Ilya. Thinking about the seasonal timeline where we are right now, because this is the time of the year when vol goes up, when bonds tend to do a bit better. You see consumer staples, healthcare, utilities. Like, this is the time of the year. Biotechs, household goods, real estate. I don't know. I'm looking at XLP. I'm looking at ITB. I'm seeing the industries that typically do well in the more defensive cycle of the year, part of the year, start to stick their neck out a little bit more.
I mean, I think there's something to be said for that, obviously. I mean, these seasonal dynamics are not seasonal dynamics for no reason. And they come back time and again in some version or some kind of broad sense. I think it's very important to both be mindful of seasonal dynamics without assuming that they're going to be exactly the same every year or that they have to hold, because that's obviously not the case. They don't have to hold. Oftentimes, in sort of extraordinary years when markets break away from extremes, those are the years where seasonals go out the window. So, and we're worried about that kind of a thing here. So
yes,
I wouldn't get necessarily ginned up about, oh, well, none of it matters because seasonals. That's just nonsense. So it is important to look at seasonals, and there is something to be said for what's going on here. I also think that there is a kind of, it's easy to misinterpret what's going on here and say this is just seasonals instead of this is a growth scare beyond the typical seasonal stuff. Because we know there is a growth scare. Again, I come back to what we saw last week and again today. Last week, we could not get anything from these stock markets but for one day, CPI day, when it was flimsy rosy. Flimsy rosy. The core inflation number surged. Oh, goody. The headline was 0.1% better than expected. That was it. Markets loved it. Could not move an inch in the S&P for the rest of the week and ended up actually down for the subsequent 3 days on Nasdaq. We get flimsy headlines today with Sam Altman, and the markets bug out. This is a sentiment extreme. Markets don't jump like this on nothing when everything is normal and seasonal factors are holding and it's sailing per the usual. This is not that.
Dylan, can I give you something here for the way out the door?
Hell yeah.
XLU, utilities, we've had our eye on all for a good chunk of this year as a corollary to the AI play. Going back to when we had DeepSeek come out back in January, we really started thinking more about the utilities, generally speaking. Let me tell you how real this is. My area doesn't have any AI data centers being built in it right now. I've done the mapping. I've checked this out. There's some stuff in Wapager Falls. There's some stuff in Yorktown Heights, but there's nothing being built related to AI data centers specifically. And yet, because of demand for energy that's been increasing in my area, there's a new proposal from Con Ed that's making its way around that would bring us a 27% total bill growth across the 2026 to 2028 windows, because it's getting more difficult for us to pay for the infrastructure and grid upgrades, given the demand that we have and what we have to give elsewhere. So utilities probably still are pretty well positioned. People are going to need the energy from somewhere. I'm going to be doing my part tonight and speaking out against the rate increase, which the board has to approve. And I will be doing my best to make sure that my electricity bills will go up.
You're really concerned about the electricity situation because I know you're a good citizen. I could make one recommendation, which is that you stop your air conditioning is killing us. Shut it down.
Nope. Turn back on Indian Point. That's the solution. More nuclear, more abundance.
Shut it down, pal.
Nope.
Just put on your underwear and walk.
With that, Dylan Radigan is out of time on overtime with his anti-AC rhetoric.
Baby.
Please mute him. We'll be back tomorrow, same time, same place. As always, 4 p.m. Eastern, 3 Central.
Way.
Right after last call for Ilya Spivak in San Francisco, Dylan Radigan in a sweltering Milan. I'm Chris Vecchio in a beautifully centrally aired New York. Good luck trading. More macro money after this with Ilya Spivak here on Tasty Live.
See you there, everybody.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
I got Joe in Houston. What's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. I think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
What does it mean when you hear can't buy an uptick?
When a stock can't buy an uptick, it means that the stock just continues to go down every single day, every single minute, every single hour. It's a phrase to use when a stock just continues to go lower. What's it mean when you eat like a bird and shit like an elephant?
Eating like a bird, shitting like an elephant. That means you're probably picking up a couple pennies here and there on a trade. And then you might have one trade where you get a little too big for your britches. You have that big loss and it kind of wipes it all away. So you're pecking at profits and then you piss it all away.
What does it mean when you get whipsawed?
Ooh, when you get whipsawed, you are basically selling into the hole or buying into a big rally and then the opposite happens. So let's say you have a strangle on and the stock rallies towards your short call. If you roll up the short put to add more premium to the position and then the stock drops, you have effectively been whipsawed.
He gets to break as many computer mice as he wants. He can just smash as many as he wants on the table.
If you had to swap jobs with anybody in this office, who would it be and why?
I would like to swap roles with Vanetta for a day, just so I can, talk smack about Tony and Tom for like a full hour in the morning. That would feel kind of nice. Just like a roast to start my day off.
Oh, God. That's a good question, actually. For a day? Forever?
Ever.
Forever?
Ever.
Oh, no. I mean, Tom has a hard job. He's got to wake up really early. But he gets the privilege that he gets. He gets to break as many computer mice as he wants. He can just smash as many as he wants on the table. He can pretty much yell at anybody. He gets first dibs at the lunch line. I think I would, maybe Tom, but I probably wouldn't last very long, yeah.
Probably Dylan Radigan, because he lives in Italy. And I live here in Chicago, so yeah.
If you have any questions, feel free to toss them in the chat.
If you say way to go out on a ledge, what are you doing?
Way to go out on a ledge is just another expression when you make fun of another trader who's not willing to take any risk, who's very risk averse. So when somebody's very risk averse and doesn't want to do anything risky, you say, "Hey, way to go out on the ledge."
When you say you're going to whack the bid, what are you doing?
When you whack the bid, that means you're selling at the best available price.
A scoopy.
Scoopy! That's one of my favorite. That's when you're just like scooping something at the bottom, like, you bought something and it never goes lower. Scoopy.
Back in the pits, you guys call them teenies. What are teenies?
A teeny is a 16th. So before we went to decimalization, we used fractions. And we used 16ths under a certain dollar amount.
Do you want the penny or the position?
Well, that's always something. The penny or the position is, do you want the trade? Then just pay up to get the trade. But do you want to squeeze it for a penny? That means you're just going to wait until you get filled.
When you say Omaha, what happened?
When I hear Omaha, I know I've gone too far.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Having trouble understanding what your trader buddies are saying? Here's what it means when they say catch a bid. The term catch a bid is in reference to the stock's price action. The bid price is the price at which you can sell a stock at. When a stock continues to go down, so do bids, meaning the price at which you'd be selling the stock is continuing to go much lower. If you miss it, you can't catch a bid.
On today's Trader Taste Test, we are going to the first Chicago location of Voodoo Donuts. Let's go. Okay, you guys.
Voodoo.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The markets finally sustain some real damage. Not surprisingly, we have the first bit of Fed-related news immediately on the horizon. I'm going to unpack what happened today, why it seems that happened, and where we go from here as this event risk looms. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we're going to begin with a look at the market performance today and what all of it seems to be telling us, and then get into episode 1 of this week's Fed back-to-back event risk, the minutes from July's FOMC meeting. Of course, episode 2 will be the speech from Fed Chair Powell at the Jackson Hole Symposium on Friday, but more on that later this week. So let's focus on first things first here. The S&P down just about 0.5% today. NASDAQ down almost 1.4%, and a very clear kind of risk aversion flavor to markets here. Dollar up for the most part, with the exception of the yen, another usual risk-off beneficiary. So down against the yen, but up against the euro, up against the pound, and really scoring its biggest gains on currencies not on the screen here, the Australian dollar, the Canadian dollar, those things that are tied to cyclical considerations. Those things that are the most sensitive to what stocks are doing and the most sensitive to risks to the business cycle, namely recession risk. Moreover, interest rates are down, and especially so at the long end. Interest rates down for the 10-year, down for the 2-year, crude oil down, gold down against a backdrop of a stronger dollar despite weaker yields. Bitcoin, of course, the sort of risk sentiment on steroids asset of the mix on the screen here, down almost 3%. So what happened here? Well, the sea of red does seem to be at least somewhat related to comments from OpenAI CEO Sam Altman that said that AI is in a bubble. But how unusual is that really? We don't have CEOs historically in the business of talking things up. No, usually they're in the business of talking things down. And that's, of course, because they would like to under promise and over deliver. So when we look at those comments and consider sort of how much credence we need to be giving them, the real question isn't so much whether those comments are to be taken at face value or whether they're the thing that actually drove markets today. The question is, why did the markets choose to respond? And it's the fragility of the environment absent those comments that really sticks out in that sense. It certainly wouldn't be the first time that the CEO of a company tried to tamp things down so that expectations could be bested later. Rather, it seems like, not surprisingly, we are back to Fed watch mode, and that was the real catalyst here because we have critical event risk on the horizon in less than 24 hours. So consider the positioning here. This is the S&P 500, and there's two things to really take away from this. The first is that right here was last week's only meaningful move, and that was the US CPI report. In the 3 days after that data, the S&P went absolutely nowhere, and its net change, but for this, it's basically nothing. In these 3 days, the S&P moves a grand total of 0.05%. And then when you look at what happened in this move today, what you see is that you had this high here. There was a breakout through that high here. And on today's move, that breakout has been clearly overturned. It's not very much different in the NASDAQ. You again had a high right here. You broke that high on CPI. In the days after CPI, NASDAQ actually fell down about 0.5, 0.6%. And then you get this sell-off today and undo the breakout. So if there was a sequencing here, let's say similar to this, where there was a pullback, here was a high, you broke that high, and then you found momentum to the upside, here, a similar attempt fizzles. Here, again, there's a clear resistance line here where there was an attempt at a breakout. That attempt is successful right here, and there's follow through. Similar here, range, breakout, follow through. Here, you have that breakout. It holds briefly and has now failed. It's the same thing here. This has now failed. So what is it about this that was so specific that it hurt market sentiment to this extent? Because it seems like a stretch to say that this was just Sam Altman. As far as Fed rate cut odds ahead of this event risk, we have generally an unchanged picture. Yesterday we were at 83.16, 83% chance that we'll get a rate cut in September, 16% chance that we hold. Now it's closer to 85.15. So the actual probability structure for September's meeting hasn't changed all that much. But that's hardly the object of speculation. As we can see here, the markets have been hovering at about 50 basis points, give or take, going all the way back to May. So, and that, of course, lines up exactly with what the Fed wrote down for their summary of economic projections in June, which is the last time they updated this thing. The current median rate for Fed funds, we can see that the range here is 4.5 to 4.25. The median there is 4.4. 4.4 down to 3.9 is a 50 basis point cut. Well, that's there, and the market agrees that that's where we need to be and has generally held there for the past 3 months. The controversy, the speculation, is occurring here in the outlook for next year. And here, over the past several days, we can see we've actually unclenched a little, where the market is less so convinced that it is going to get as much easing as it did, let's say, a week or 2 weeks ago. At that point, we were looking at 125 basis points because for this reading here for next year, we were at fully 75 basis points priced in. We've been coming in, and we came in a little bit more today, down to 66 basis points. So we've said that a rate cut cycle for next year now is 2 cuts at least, but the third is only about a 60%, 65% chance of occurring, whereas very recently here, that third cut was fully priced in. Moreover, we can see the Fed's own outlook is for a single 25 basis point cut. So the market is clearly saying they want more cuts than the Fed has said. So the markets want more easing. So if there is a shift where that more easing is diluted in its probability, well, the markets aren't going to be happy. And it's not surprising then that before we see the release of minutes from July's Fed meeting, the first inflection point in this Fed story this week, the markets are going to feel like maybe if they're one-sided, they need to even out the deck a bit. Now, we know why the markets are so jumpy in the face of all of this. Again, we can see it in the price action. When the Fed news flow is relevant, then we get some kind of action, and outside of that, nothing. So clearly the markets are paying attention to one kind of thing here, but it is important to consider why. Now, we know, again, why the markets cheered that CPI report. It was refreshingly normal looking. Most inflation still in services, goods inflation higher in its contribution, but not running away seemingly. And the headline number was expected at 2.8 and came in at 2.7. And even though the core was expected at 3 and came in at 3.1, the market seemed to really latch on to this bit to say, well, that's not so bad. Maybe we really will get our rate cuts. Incidentally, that's despite goods inflation going up, services inflation cooling. But that we didn't find follow through later seems to be linked to what we saw in producer prices, which jumped and did so because producers' margins expanded by the most, incidentally, in almost 3 years. And that suggests that tariff costs are now being passed down to consumers. And that's the kind of thing that might keep the Fed from going as hard on rate cuts as the markets want. That, of course, still leaves the question, why do the markets want those rate cuts so badly? Well, we know that there is an emerging threat to growth. In fact, even Chair Powell himself acknowledged as much after the July meeting at the press conference. We likewise know that the tenor of this conversation seemed to deteriorate a bit. This is the statement from that July meeting, and we can see that policymakers pointedly took out the bit that says economic uncertainty has diminished. Moreover, we know that there was a break from consensus. For the first time since 1993, 2 Fed governors preferred the more dovish outcome and voted for a cut. And so, not surprisingly, the question for markets here is, does this suggest that there is a dovish consensus from July that's taking hold here? If the Fed was already getting closer to cutting rates, and if we already have dissents on the committee saying the economy has deteriorated enough that we need to make this move, what has the evidence shown us since? Well, the evidence has continued to go in this direction, even as we get these signs of inflationary pass through and consumers starting to take on these concerns. We just saw last week that consumer sentiment weakened as inflation expectations rose. And this really speaks to what the markets want and why they want it. As we've said many times before, global growth is primarily powered by 3 economies: the US, the Eurozone, and China, that account for 58% of global GDP. The remaining 42% are mainly vendors to these 3 and depend on them for demand. So it's really on these 3 economies to make or break global growth. And so if the markets were to consider that there is some sort of growth concern, well, then, not surprisingly, they'd want rate cuts. And sure enough, that's exactly what we have. Of the three major engines, looking at the latest PMI data, we see the Eurozone and China are at standstill. As ever, these are centered around 50, where that's neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. That the Eurozone and China numbers here are hugging 50 tells you that those economies are barely moving. The U.S. economy seems to be carrying all the weight. We saw that last year. There was a bit of a spook here, obviously, at the start of the year with the tariffs, but it seems like we're back to relatively strong U.S. growth, looking at least the S&P global version of this data, which is what we're looking at here. But if we consider where sort of timelier data has moved since then we can look at the ISM version of the very same data as we've done here before, also a PMI report. And we can see that on this measure, we're at standstill on U.S. growth, suggesting that already there is the risk that if this is the only leg of the stool that's keeping things standing, it is already fading. Moreover, of course, we saw in the second quarter GDP numbers that consumption, which is 68% of overall GDP, was the weakest for the first 6 months of this year in 5 years, going back to the 6 months that were the COVID recession in 2020. We also see the apparent absence of demand, because whereas in the first quarter imports surged, which would mean that they're a larger negative pull on GDP. Imports are typically subtracted from GDP. And inventories surged as those imports went into stock piles to try to get as many goods at the pre-tariff rates as possible and keep consumers as insulated from those tariff costs for as long as possible. In the second quarter, imports collapse. That's them being a positive contribution now. And inventories go down. So those inventories are being spent and they're not being refilled. In other words, demand is expected to be weak by the people that expect to sell into that demand. And that's despite the fact that in the second quarter, you still have pauses on tariffs in place. So you could still be front-running tariffs at that point and filling up inventories with relatively cheaper goods. But that isn't happening. So we already see that the view on demand is soggy, and we already see that it's soggy in the most important part, consumption. We likewise see that as this pass-through of inflation starts to happen, as we just saw, consumer sentiment is souring, suggesting that going into the third quarter, the consumption picture isn't going to be that much better. And that, of course, brings us back right here. If this is stuck, and this is stuck, and this is the only thing that's working, except it seems to be starting to misfire, well, then it isn't just the US that needs these rate cuts. It's the world economy as a whole. So it isn't surprising whatsoever that the markets rabidly want them. So even the slightest bit here that would suggest that those rate cuts aren't coming ends up being an action-packed headline, which of course isn't helped whatsoever by the fact that, this is a chart from Bank of America, by at least a range of valuation measures, the market is very, very frothy. This particular valuation metric, and you can pick your poison, there's a sea of these, but this particular one is especially eye-catching, coming at you from Bank of America research here just over the past 24 hours showing that on a price to book value ratio, we're basically in dot-com bubble territory. And so you start going down the list and start to say, okay, well, if the story was AI exceptionalism, we've done that. If the story was wars in the Middle East and the Russian-Ukraine theater, listless crude oil has told you that the markets aren't really paying attention to those things as macro relevant. And so you start to ask, well, what is holding up sentiment then? It isn't the breakout of peace in either one of those theaters, and it isn't seemingly endless room to run on tech evaluations. So what is it that the markets have to hang their hat on? And the prospect of rate cuts in the face of an economic threat starts to be one of the few things, if not the only thing, left in the quiver. If you start to take that away, if the minutes from this July FOMC meeting suggest that this descent is not the makings of a Fed that is going to jettison its caution and that is going to follow through on this much more dovish view for next year than it has so far owned up to, well, then sentiment doesn't have very much of a leg to stand on. And that's how you end up with days like this and days like that. And that is macro money for today. As ever, we are here right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Chris and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
What's your sleeper pick for the second half of 2025? Is there anything that you're particularly high on nobody's talking about?
My sleeper pick. I think Ethereum is an interesting play. It's still a lot. It's near the lower end of where it's been trading at 2,500-ish. If you are bullish on the crypto space, which I am, and I think the blockchain technology is a huge part of that, I think that Ethereum has a little bit of a catch-up trade, and you can now trade it via the ETFs. ETH-A is the Ethereum ETF, which is now accessible for option traders. So I think that's an interesting play. Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
What's a macro risk right now that people aren't talking about enough?
Complacency is one. There's a lot of bullishness around. The street is very complacent. There's very little cash on the sidelines. And I think there's just, in general, the regulatory environment is too good, so people become overconfident.
I still think the geopolitical thing is very, very interesting. Frankly, I've had a tough time kind of parsing out the headlines in the news lately. I guess I would say like this ongoing discussion of just different conflicts that are going on and how it's pushing and pulling different asset classes. That's a super diplomatic answer. I'm not unaware of that. I think it's really important to kind of be mindful of your positions when there is so much talk and uncertainty going on and making sure that you're always controlling your size.
I mean, the dollar's depreciated over 10% against the euro and some other major currencies. I don't see how that doesn't start to play into some companies' earnings and their fiscal reports.
What is going on, everybody, and welcome back to Risk and Reward. Today's Tuesday, another risk of the week. We got a couple positions that we put on here, which we're going to share here in a little bit. But before we get into that, I hope everybody's had a great start to the week. Gus, how we doing? How's everybody doing?
Doing well, feeling good. First live show since we got to meet so many wonderful people here in person at our event in Chicago. It was great to meet all of you. Emmett, I was just congratulating you off air on your #1 ranking in our chat here. You to GOAT. But yeah, which led us into a conversation about Emmitt Smith. Errol was telling me that he taught Emmitt Smith, the football player, how to trade options.
Yeah. Very, very random fun fact. Emmitt Smith had messaged on social media before, and he was just like, "Hey, bro, your link's not working." So we got him the link, reconnected, hopped on a Zoom, just showed him the ropes of options, and which is actually pretty cool to think about. Guess what options platform I was using at the time? Tasty Trade. So, that was the first time
Emmitt Smith confirmed Tasty Trade.
Tasty Trade. I know, on the headlines. No, but I remember just thinking like, "Hey, Emmitt Smith, trying to play it cool, trying to not be like." No, this is.
What's up, playa?
What's up, bro? I was waiting for you to reach out. No, but I was just like, hey, do you mind real quick if I run downstairs so my dad could say hi? So I remember we ran down there real quick so he could say hi. Used to watch him on Dancing with the Stars, and that was like more of the, Emmitt Smith, he was the Hall of Famer running back. But I'm not a Cowboys fan, so I don't really care anymore. No, I'm just kidding. I'm not a Cowboys fan, but a little bit of a sidebar we had.
Yeah, so. Yeah, it's a great little anecdote. Emmett, I'd love to show you the guns, but I like this shirt. You know what I mean? So I can't be breaking those out.
I think it's concealed carry out here. So concealed carry.
He does spell his name differently. That's true. I think Emmitt Smith has double T's going on.
Is it?
Yeah.
It is.
Yeah. Pretty sure.
Anything else over the weekend? It was a great time last Friday, seeing a lot of familiar faces on social media, doing those kind of things. Anything else before we get into the segment for today?
Yeah, no, nothing else. Excited to jump into this risk of the week, and then I got one other topic I'd like to talk about. I guess one other stock I'd like to talk about. I'm thinking about taking a position on tomorrow. I wasn't feeling crazy enough to go double risk of the week.
Is this underlying moving after hours right now? Or is it something you just want to circle back around to?
No, it shouldn't be moving after hours.
You already got me. I'm curious what it is.
Yeah. So, and honestly, I'm kind of blanking right now. I'm gonna trust that this will come back to me throughout the course of this thing. I'll figure it out.
Cool.
Anyway, risk of the week, as you all know, or if you're new here, Errol and I put on a short-term, high-risk trade every week and recap them here, or I guess talk about them here, and then recap them after they are closed. So let's dive straight in. You're leading us off.
So, I know, a little controversial, but this risk of the week, I wanted to go with UNH. We went with UNH one of the other weeks. We also spoke about UNH last Friday after Warren Buffett decided to take a position, or Berkshire Hathaway decided to take a position in UNH. But because of the short-term hype, because of the short-term momentum and rally, I kind of want to fade that sentiment a little bit, at least in the short term. So today I chose UNH. I ended up selling a September 19th out-of-the-money call spread, shorting the 310 calls, buying the 315. So it's only been a few days since after the announcement, and I mean, just looking at UNH stock, if we have a little bit of time here, we can look at it, but just looking at the underlying, it hasn't done too much post-initial hype run. So maybe we digest a little bit from here. But price action, recently strong price action that we've seen, big catalyst, trade rationale is really just fading the hype. So we'll see how UNH plays out. Got a lot of time on it, and it's a little bit more speculative. I received about $1.80 in credit, so we have a little bit over $3 wide of risk on that iron condor, but we'll let it play out. Got a little bit of time on it. Your thoughts initially off the bat for UNH?
Yeah, I think it's an interesting one. It's certainly contrarian, which is what we try to do here.
No doubt.
And yeah, I mean, I don't know. I think that there may be some merit to it because, on one hand, you know, I've been saying this whole time, and the reason that I am long UNH is because the company fundamentals are still largely fine outside of some outlying regulatory uncertainty here. But at the same time, like, this whole run-up has just come because of the Buffett buy,
Right.
and it also is not really substantiated by anything that has to do with the fundamentals of the company. And ultimately, the efficient market decides what the company is worth. And so I could foresee a situation where this does take a little bit of a what's the opposite of a dead cat bounce? An alive cat dive.
Continuation.
A live cat dumble.
Live cat dive.
Tumble.
We can call those the dolphin dives. We don't use that. We don't use that term in trading.
I don't think we do.
The dolphin dive.
I don't think we
dolphin
do.
diving.
Sure. Yeah. Okay. Animal move strategy here. But yeah, I think it's certainly possible that this breathes for a little bit before we're taking some more momentum on. So we'll see.
Yeah.
I also I just looked into it earlier today. I was a little bit misled, or I don't know. I had convinced myself that reality was not the situation, but their entry point is actually very close to 300 on UNH. So it's not like they grabbed it way down at the bottom in like the 240s or 250s and are just now disclosing it.
Right.
So Warren Buffett and Berkshire Hathaway, really just Berkshire Hathaway, Warren Buffett is hardly there anymore, need this thing to move up a considerable amount further, which makes me feel good as far as my long leaps go. But yeah, I mean, I think there's some merit to this.
Yeah, I like it.
We'll see. It's risky, but that's the whole
Risk of the week,
that's
baby.
The whole
Let's get
freaking
it.
point.
Yes, sir.
So yeah, good one.
Cool. What do we got for risk of the week, Gus?
I am on Vistra Corp. VST is the ticker. I do not know what this company is. I do not know what this company does, but Nancy Pelosi bought it in January, and I raced to follow her, and holy cow, it is 2x this year. I wish my calls were naked and not defined risk, but it is what it is. But I'm getting even further bullish here again. This is a really rare technical analysis play out of me. We'll hop over and look at the charts here in just a second. But I've been long, like I said, since February. I've been watching it closely. It's something I check in on multiple times a week. And I've come to notice this trend that VST likes to operate under, where it will explode upward for a month, it'll breathe for like 10 to 14 days, and then it will make higher highs again. And that's been the pattern throughout this entire year. It happened in May, June, and July. April kind of non-withstanding because of the Liberation Day stuff. But I mean, if you want to count the Liberation Day sell-off and then recovery as the April dip, you could do that as well. And August is showing us the same trend. It made all-time highs on August 4th. It has bled downward ever since then to slightly below $200 now. It closed 193 today. And there's some consolidation happening at the bottom of this range. I've seen this pattern play out a bunch of times before with this specific company, which I think technical analysis has a bit more merit when you're talking about a pattern within a specific company and not just, oh, this chart is a cup and handle right now. And so, yeah, I'm just hoping that trend will continue. We'll get a nice little bounce. I think 200 before the end of the week is very reasonable. This thing moves quick when it does move, and potentially, 220, which would be another all-time high sometime in the next 45 days. But I, in particular, am on a bullish put spread for August 29th cycle, which is 10 DTE, I guess 9 DTE now that the market is closed today. I'm long the 192.50 and short the 197.50. I collected about $200 in on that one, so we'll see what happens.
I like it. We'll have to take a look at this chart here in a little bit, but I mean, you're feeling bullish. So we got a bullish put spread, 192, 195. Do you remember how much you paid for that one?
Yeah, I think low twos.
Oh, low twos, right. That's what you were just saying.
Yeah.
That's nice.
So, yeah, not too bad at all. It's at 193 and some change right now, so just need to move back up to over 197.50. I don't even need the 200, but I think that this will be mighty profitable by the end of this week, I say.
No, I like VST. I don't think VST is one I traded too much. I know right now there's a lower IV rank, probably why you wanted to get long those spreads rather than maybe sell them. Lower IB rank.
Yeah, and there's some put side premium as well is part of the factor on that. So yeah, it's just that's what I got.
No, I like it. We can dive into the platform here. We can check out some of these underlyings. Check out UNH, VST. Do you remember that other underlying you had in your head?
Yes.
I'm curious. I want to.
Yes, it has come back to me. It's Wynn is what I want to talk about.
Okay.
Yeah, Wynn casinos, resorts, all that good stuff. Wonderful production team. Thank you very much. And there we go. Okay, let me hop over here real quick.
I do look like I got a
professional. I'm signing into my platform right now.
It's okay. In the meantime, we have some FOMC Fed minutes this week. I think we got Jackson Hole on Friday too. So we've already got a lot of volatility before that. So maybe we get even more. But Monday and Tuesday didn't disappoint in terms of volatility.
Yeah, I'm interested to hear. I'm interested to see what happens with the Fed at large coming up. I know that there's conjecture about there may be justification for a 50 BPS cut in September.
Yeah.
Poly market, which is kind of what I look to, is the efficient market, is not giving that very much of a puncher's chance. And I'll tell you what, it's like the closest I've ever been to creating a poly market account is right now, because I want that 20 to 1 on 50 BPS decrease.
Right. No, 100%. I mean, if anything, it's like poly market is a pretty efficient market. If anything, I feel like it would reflect sentiment pretty well.
Oh yeah,
it's
really cool. It gives us,
right.
it gives us the ability to have efficient markets on things that you otherwise couldn't, like the presidential election or whatever it may be.
Because we always have that hunch for sentiment, but one thing that's going to forever change, I think, elections is being able to look at poly market during live elections.
Yeah, well, and it not undermines, but it works in place of polling.
Right, absolutely.
Because you're letting the efficient market decide it instead of trying to create a statistically significant sample size and figure out how you're going to remove biases from political polling, which is always the most challenging part. And so, it just gives you a good top-down look at what's going on.
Yeah.
VST here, let me expand out a little bit. So you can see here, these are one-day candles, but this is the Liberation Day sell-off into April, and then coming out of April, we have small dip at the end of April, recovery. In May, we get small dip, recovery. In June, we get small dip, recovery. And then here is July's small dip, recovery to all-time highs. And then here's where we are now in August. We've come back down off that dip. This thing, and this also, this is not some revolutionary concept. Companies that are having good years, good seasons, whatever it may be, do this. This is how stocks move. I understand I'm not really blowing the roof off anything here. Just trying to capitalize on these recurring breathing periods. Anytime you can find one stock that likes to operate within its own channel, that can be a profitable angle. That's where I'm at on that.
IVR was in the 90s at the lows early May. IVR was in the 90s and has just been decreasing since. I mean, volatility's been getting blown out of the water.
Yeah. Oh, I just opened Berkshire Hathaway. Like, that's what you have. That's not what you have. UNH. And then obviously the situation with UNH, we've recapped it a number of times before. Things went poorly for that company over the last 365 days. Then we get the Buffett bump here, and then perhaps we will get the dolphin dive.
Yeah, we might. Caught me off guard. We might end up getting the dolphin dive.
We got to coin this, man. Everybody's got things. Liz and Jenny have the jade lizard, and Nick's got the crab trade.
All right, if we like the dolphin dive, we'll test it for the next week or two. If it sticks, it sticks. If it doesn't, then we'll find a placeholder.
We'll feel it out.
But I like it. I know we have a really big gap. And there's always a lot of opinions on gaps, and if gaps should be filled, it's not really the reasons why I really want to
be. This gap is getting filled. Damn it!
Sitting down there at the bottom, like I'm waiting for this gap to get filled. No, but just a little fade on Warren Buffett in the short term, at least, right? We're not trading same time windows.
Yeah, it's true. All right, this leads me into Wynn Resorts.
Right
now, Wynn, they just had a solid earnings call, I believe, last week. Maybe earnings coming up this week. Anyway, point is, I'm thinking about getting short on Wynn here. And my logic for this is that I'm a big fan of gambling stocks.
Right.
Gambling is on the up and up. And so your DraftKings, your Flutters, your Caesars, those I'm fine with because it's widely accessible. Those people are in all markets where sports betting is legal. It's a nationwide thing, and it's growing. My issue with Wynn is that they have no online gambling presence at all whatsoever. And to my knowledge, they only have resorts in Vegas. I guess they have resorts around the country, but this is not a nationwide thing. Nobody has Wynn in their pocket. Nobody is pulling out their Wynn app to get some action down on the game tonight. And it's at all-time highs, and it's tested these levels a number of times before. Let me expand even a little further here. It's tested these levels a number of times before and has ripped back down off of them. The stock is just incredibly volatile in general. And I think that unless something gives, and you guys can let me know your opinions on this in chat, but I think Las Vegas is like dying.
So, right off the bat, though, Wynn hasn't transitioned towards, you said online gambling yet, or like an application to be able to speculate?
Just an app where you could gamble.
something.
Yeah, I mean everybody's got their
Right.
sports betting app. Caesars has an app. I have Caesars on my phone.
Yeah.
DraftKings and FanDuel, Flutter are obviously
Yeah.
like just app based. But this one, Wynn, to my knowledge, does not have any way you can gamble just from your phone
Right.
in any state. And I think this is just pure resort hotels is kind of what we're buying into here, and the gambling revenue that they generate from those. But I have kind of a broader thesis, and this isn't a uncommon take or a hot take at all. But yeah, Vegas is just it's getting too crazy. Their gambling revenues are falling. They see slot revenue falling. And it's because everything has gotten so ridiculously expensive. Vegas used to be a nice, a fun place that college kids could go and stay for pretty cheap. And the comps were very competitive everywhere. Everybody was giving you constant free stuff. And when they're upscale, which is the new tourism in Vegas, is upscale people with money to spend. But I think that it's just, the opposite, I suppose. Lowering tide lowers all boats. Yeah. And I think that as Vegas travel continues to be hurt more and more until they figure out that they have to actually lean into what the player wants to increase travel again, that the prospects could be bad for Wynn. So I feel like testing all-time highs here, actually at all-time, well, no, not quite at all-time highs, but testing all-time highs here, this feels like a good 180-day short sort of situation. I feel like we could see a dip back. I mean, it's at 112 right now, and at the bottom of this, well, I guess this is Liberation Day. Let me pick a better dip. At the bottom of this dip in January, it's at $80. So, like, you're telling me we're up almost 50% from January of this year? But, I mean,
Make it make sense.
Yeah, I'm not seeing
No, I hear you 100%, especially because it's related to casinos or resorts, those type of things. Like, if people's disposable income goes down too, and inflation's
That's true
high,
as well. As inflation increases,
Right.
people have less disposable income. They're going to spend on travel and do those things.
Absolutely. And it's like if you're going to pay for food, gas, whatever it might be, you might cut out Las Vegas first. Yeah. So if things are taking a turn, not that they ever do in this country, if they are, would places like those get hit first? And would that even, piggyback a little bit off of kind of what you were saying there a minute ago?
Well, yeah, I mean, gambling is like as far as you can get into consumer discretionary spending. Like,
Right. And the polls, the strip club.
Yeah.
Right.
Yeah, exactly. And it's all just, and in Vegas, slowly things have become more and more expensive. I just recently saw, actually about the Wynn itself, an article that they're selling bottles of Dasani water for $13 a bottle.
Yeah.
What the hell are we talking about here?
Right.
No, that should be ridiculous to anybody.
Right. That's absolutely price gouging.
Yeah. Oh, yeah. And it's happening across Vegas. I remember seeing a story last year from last football season about a guy in Allegiant Stadium ordered 2 pizzas in his suite, and it was $600.
Yeah.
And it's like, what are we talking about?
No, I believe
and he
it.
was a very wealthy guy that was
Yeah.
tweeting to complain about it because it's still just obscene. It doesn't matter how much money you have. And that sentiment is perpetuating all across Las Vegas. And then in addition to everything growing more expensive, the rules keep getting worse and worse for the player. I was just in Vegas last summer, and there is, outside of Treasure Island is the only one, there is not one casino on the Strip that is offering 3-2 blackjack. It's all 6-5 blackjack, which means that if you get a blackjack, your payout is 6-5 instead of 3-2. And over the course of a long session, if you sit at the table for an hour even and play 50 hands, that really kills the player. I mean, that takes your house edge. That takes the house edge up a lot. And people go to Vegas to gamble. And if Vegas is trying to make this pivot and make itself just a vacation destination with the Sphere and with these sports teams that they're getting and all the concerts and all the shows, I understand all that's lovely, then they can try to go for that. But I just don't see who's going to choose to, especially incredibly wealthy people. I don't see who's choosing to go to Vegas
To see those other...
Yeah, versus, L.A. or the freaking Maldives.
Right. So Vegas wasn't something that I found a huge interest to, just because I never had people around me that wanted to go or this or that. But the first time I was in Vegas, I was 15, 16 years old. I was over there for a basketball tournament. So I kind of got to go down the Strip, kind of get the vibe, the excitement, the energy. I haven't been there since, but I could imagine, and from what I've seen and heard on social media, Vegas isn't like the Vegas, and just the brand of Vegas and Las Vegas isn't the same brand as it was, 10, 15, 20 years ago, too. Yeah. The behaviors of speculators also just changing? Like maybe they're going to draft this, that. Maybe they're going to DraftKings FanDuel, that on top of the discussion we just had about disposable income going down, the extra speculating dollars might be going elsewhere too.
Yeah, and that's the thing too. I mean, especially in the case of sports betting, like Vegas IRL sports betting revenues are
really
the lowest that they've ever been. Yes. And
give us a quick synopsis of IRL sports betting, just so we get an idea of what that looks like.
Sure, yeah, like walking into a sports book in a casino, which is the area where you place bets on sports, and walking up to a counter and handing someone physical cash and saying, I want the Bengals today. And then they give you a paper ticket and you sit in the sports book. Yeah. And I mean, in the good old days, you'd have 2-3 free drinks while you watch the game if you're a big player. Not even that big of a player. You throw down $500, they're going to treat you like a king in the 80s and 90s and stuff. And then you go collect. If you win, you go collect. They pay you out in cash. And that's how sports betting worked. I mean, really, like until very recently, until the wide scale legalization, was you had to go to Vegas and do that. And now that sports betting apps are so widely legal domestically, there is a great decrease in people feeling the need to travel to Vegas and bet on sports if that's their market. And then beyond that, just on the day to day, even people who live there, they've switched now to where in Nevada, because they're still trying to protect themselves, you can't. You have to actually go to casinos in person and deposit money, like cash money, into an account, and then you can bet from an app.
Right.
So there is still money coming into the sports books, but people actually going in there is different. And I want to say too, I love Vegas. I don't mean to condemn Vegas at all. I love it. I try to get out there once a year. I find it to be very enjoyable. As Laid Back Trader said, casinos, it's not the same as online gambling. It's not the same at all. There's vibes, there's ambiance. You get to make friends with the dealer. You get free drinks coming around. It's still a fun time. But I just think that the things that I love the most are starting to fade. Vegas is fun the first weekend of the NCAA tournament. I'll give you one there, Mike. Vegas, it used to be fun the first weekend of the NCAA tournament. Last year, in Circa Sportsbook, if you wanted to go to the opening weekend of March Madness, it was $300 just to sit in the sportsbook. $300 for a ticket to sit in the sportsbook for the AM session, $500 for the PM session, or you could save $50 and pay $750 and have your seat reserved for the whole day. And that's just to be able to bet. That is just to be able to give them your money at 11 to 10, which is the craziest thing. Yeah, so Vegas, I think that things need to shift. I think that people need to figure out that people come to Vegas to gamble. That is what you're known for, and you shouldn't try to abandon that brand. And you should be the best place in the entire world for the player, and travel would resume. But it's just not that way at all. So that all leads me back to my thesis about Wynn. I think this thing has to be overvalued right now. I wouldn't be surprised if one of their next 2 earnings calls just goes poorly and knocks them down a peg. But we've seen this thing take giant swings. I mean, I was just talking about that dip in January, but we touched 107. We go all the way back down, sub 80, 76, 76, and then now we're back up to 112. So if I manage to catch a move like that again, it wouldn't be any problem at all.
I mean, just by the looks of it, this is a trader's stock. I mean, if you just look, what are we on, the 1 year? We're on the 1 year. This is the last 365 days, and we traded at the top end of this range and at the bottom end of this range within the last 12 months. It's a lot of ground to make up in such a short period of time. So it's a volatile one, Gus. I like it.
Yeah. So we'll see. But yeah, it's a mover. It likes to go. And then let's see what other positions we got open. Anything expiring soon? This is the VST position I just alluded to today, as well as my year-long long position, which again, wish this was a naked call instead of being a defined risk long call spread. And then this Starbucks is also giving me some strife. Needed over 95 by September 19th. And it just keeps trying. I swear, once a week, this thing is at 94, and I'm like, I'm good. And then it goes right back down. It frustrates me to no end. And I mean, I guess that sentiment is backed up in the chart. Oh, we're over 95. No, we're not. Oh, we're over 95. No, we're not. Oh, no. And it keeps doing this again and again. And then, this was the most recent one. This is last Wednesday. We barely touched 95, dip back under. It's annoying me. But that's kind of it. Everything else is right where I want it. I know that these P&L days may not look like things are right where I want them, but I got all these positions right where I want them.
Look how much time is on these contracts. You went out in time. What's going on, Big Deal? Just a wee bit late, brother. I hope you're doing well. Good to see you.
That was like 5 minutes ago. He's catching the show.
Yeah, catching the show. Anybody that did tune in a little later, the risk of the week, I'm going to go with UNH this week and fade a little bit of the hype. Gus went with VST. You can see that position at the top of the portfolio working out pretty well so far already. And then we're going to be checking out Wynn tomorrow. Gus had brought up Wynn, so we'll check out how that plays out. It has a lot to do with Vegas and The money that they're rolling in over there.
Maybe we'll do the full.
We'll catch you in Vegas on Thursday.
We'll do the full.
live.
Oh, just live in Vegas.
Live in Vegas. We'll catch
Coming to you live from Circa Sportsbook. It's the boys.
That'd be hilarious. It's a Win sponsorship like that.
It's gonna be streamed on TikTok from one of us holding a phone in our hand.
Literally, Win's trying to change our opinion right now.
No, but yeah, maybe Thursday we could do a little Vegas dissertation, throw together some slides on that. I'm sure that there's all kinds of interesting
100%.
trends we could look into there. But
100%. Anything else to add before we start to wrap up today?
Anything you wanted to look at here before we pull this down?
No, nothing too much. I mean, we'll see what we get for the rest of the week. It's been a really volatile, at least today,
Hey, Rancher in chat said, join the gang, UNH shorter. Let's
join
go.
the gang, UNH shorter. What's going on, Rancher? We'll definitely put that out there whenever we close the position then. Let me know how you end up managing it.
And no worries, Big Deal. We're just hacking on you. We love you, man.
Oh, yeah, all love over here, Big Deal. All love. But no, that'll wrap it up for today's segment. Thanks for taking the time to hang out with us. Be sure to stay tuned for more segments coming on next week. We'll be back on Thursday, 4:30 o'clock Central Time. We'll see you guys next time. Peace.